welcome back to the Dukascopy Studios here in Geneva. Today we'll be discussing global market moves and what effect they could have on emerging markets. And joining me to discuss is Charles de Quinsonas from M&G Investments. So Charles, welcome to the studios.
Thank you. Hello.
So firstly, what is the investment philosophy behind the M&G emerging market portfolio?
Well, the fund is very flexible. It's a go-anywhere fund where we invest across all asset classes within the emerging market debt universe. This is local currency sovereign debt, hard currency sovereign debt, and hard currency corporate debt. The investment process is basically a blended approach of top-down and bottom-up views, with a prevailing top-down views that drives the credit research to generate the best ideas. So it's a best ideas fund aiming at maximize total return. We're not benchmark, not constrained, flexible and go anywhere fund.
And what's your view on the markets at the moment? Where do you see the value and where do you not?
I think investors need to acknowledge that the environment is a challenging one in emerging market, because you've got countries such as Brazil for Latin America, Russia for EM Europe, or China in Asia that are facing significant headwinds. However, you've got also the bright spots with India benefiting from actually lower commodity prices, Central America and the Caribbean, for instance, benefiting from a stronger US economy, and Eastern Europe that benefits from the recovery in Europe and also lower commodity prices.
And the Fed haven't raised interest rates as of yet, but it's only a matter of time before they do so. So what effect could this have on emerging markets?
I think it's a very important question, but actually when the Fed hikes does not really matter anymore. It's more how much they will hike and at what pace in the future, in the next 12 to 18 months. In terms of outflow, the main risk obviously is that if the Fed hikes more than the consensus view, 25, 50 or even more basis points, you have a risk that outflows, to see some more outflows in the market. However, since the taper tantrum in May 2013, the asset class emerging market debt has seen some benign inflows, very slower than in previous years before 2013. So we think the asset class has already anticipated the Fed hike. It shouldn't be a problem.
Great. And then looking at commodities, so commodities have fallen in recent weeks. So what impact has this had on various emerging market countries?
So that's a very important question, because on the commodity side you have two different, if I may, I would split between oil and metal-based commodities. So on the oil side, you've got countries that benefit actually from the lower oil price. Those countries are China, India, for instance, I mentioned, and those that do not benefit, such as Venezuela in Latin America, obviously in the Middle East, Saudi Arabia, or other countries, exporting countries. So you have the winners and the losers. And on the metal-based commodity side, China is very important because it's the larger consumer of metal-based commodity. So the slowdown is pressuring prices down. The slowdown of China is pressuring prices downwards, which is affecting exporting countries such as Brazil, Latin America, and in particular Brazil, Colombia, Chile or Peru.
And you mentioned China lightly there, so the China crisis, what was your opinion on it and how did it affect emerging markets further?
Okay, so as I mentioned, China has a direct impact on the price and demand of commodities first. And on China itself, I think we've heard in recent months a lot about the equity market. However, I think our view is that China's main problem is actually its debt, more than its debt size. It's 250. It is estimated at 250% of GDP. Half of this is 125% is the debt of the Chinese corporate debt. That this is one of the highest level in the world, and you have some sectors that are heavily indebted, such as construction or property developers in the country where we are underweight, because we think the size of the debt is unsustainable. I may add finally, if you think that credit will dry up in China because the growth prospects are slower than before, if credit reduces, growth will this will result in lower growth as well. So China cannot sustain such a level of debt, and they will have to adjust to lower credit in the economy.
Great. Well, Charles, thank you so much for coming in today and sharing your insights with us. Thank you. And thank you for watching. For all the latest Dukascopy updates and interviews, do keep clicking back. Goodbye for now.